Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets this week. My name is Summit Puri and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points, highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at real GDP data. And in point number 3, we'll take a look at the PCE data, or personal consumption expenditures. And in point number 4, we'll take a look at jobs data, specifically looking at non-farm payrolls. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 2.3% growth as of November 1st, which is down from our previous estimate of 3.2%. This data incorporates construction spending data from the U.S. Census Bureau, the employment report from the BLS, or the Bureau of Labor Statistics, and the manufacturing report from the Institute for Supply Management. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, the initial claims data showed a further decrease of 5.5% from last week, ending at 216,000, and continuing claims also fell to 1.826 million. We'll dive deeper into this data in point number 4, but as you can see on the chart on your screen, we've fallen below the 1-year average for new unemployment claims. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw another slight uptick in the 30-year and 15-year mortgage rates, ending at 6.72% and 5.99% respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread rose slightly from 7.79% last week to 8.58% this week. Investors are still bullish, but just slightly. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 98.9% probability of a 0.5% decrease and only a 1.1% probability of a 0.25% decrease next week. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which was our proxy for growth and growth in income, but only when considered together, ended negative 1.61%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 1.5%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was negative 1.36%. Another team takes the lead this week. International stocks are the smallest losers. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the market is performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On to point number 2, real gross domestic product. The U.S. Bureau of Economic Analysis released an advanced estimate indicating that the real GDP, or gross domestic product, grew at an annual rate of 2.8% in the third quarter of 2024. This follows a 3.0% increase in the second quarter. The increase in real GDP was primarily attributed to an increase in consumer spending, exports, and federal government spending. Consumer spending saw growth in both goods and services. The increase in exports was mainly driven by an increase in goods, specifically capital goods excluding automotive. Defensive spending was the primary driver behind the increase in federal government spending. Imports, which are subtracted from GDP calculations, also increased. Now, while the third quarter witnessed positive GDP growth, it also experienced a deceleration compared to the second quarter. This deceleration was primarily due to a decline in private inventory investment and more significant decrease in residential fixed investment. These downward trends were partially counteracted by accelerations in exports, consumer spending, and federal government spending, along with the acceleration of imports. The current dollar GDP, which increased by 4.7% annually to reach 29.35 trillion in the third quarter. Personal income in the United States increased by 71.6 billion or 0.3% in September, according to estimates released by the US Bureau of Economic Analysis. This increase was primarily driven by a rise in compensation and personal current transfer receipts, offset partially by decreases in personal interest income and proprietor's income. Disposable personal income, which is personal income less personal current taxes, also increased by 57.4 billion or 0.3%. The personal savings rate, which represents personal savings as a percentage of disposable personal income, was 4.6% in September, with personal savings totaling $1 trillion. Personal consumption expenditures, or the PCE, increased by $105 billion or 0.5% in September. This rise in spending was observed in both goods and services, with services experiencing a larger increase of 72.1 billion compared to the goods increase of 33.7 billion. Within the services sector, notable contributions to the increases were healthcare and housing and utilities, particularly housing. The goods sector saw a significant increase in spending on other non-durable goods, primarily prescription drugs, food and beverages, and motor vehicle and parts, especially new light trucks. However, this was partially offset by a decrease in spending on gasoline and other energy goods. The PCE price index increased by 0.2% in September, while goods prices decreased by 0.1%, prices for services rose by 0.3%. Food prices saw an increase of 0.4%, while energy prices experienced a decrease of 2%. While excluding food and energy, the PCE price index increased by 0.3% year over year. The PCE price index increased by 2.1% in September. This was driven by a 3.7% increase in prices for services, while prices for goods decreased by 1.2%. Food prices increased by 1.2%, and energy prices decreased by 8.1% year over year. The core PCE price index, which excludes food and energy, rose by 2.7% from the same time a year ago. The U.S. Bureau of Labor Statistics reported that total non-farm payroll employment remained relatively stable in October of 2024, increasing by a mere 12,000 jobs. This followed an average monthly gain of 194,000 jobs over the preceding 12 months. The unemployment rate held steady at 4.1%. Employment growth was observed in healthcare and government sectors, while temporary help services experienced job losses. The manufacturing sector saw a decline in employment, largely attributed to strike activity. The report highlighted the impact of Hurricanes Helene and Milton, which struck the United States in September and October. While Hurricane Helene made landfall before the October reference periods for the survey, Hurricane Milton struck during these periods, leading to large-scale evacuations in Florida. Despite the hurricanes, the household survey was conducted largely according to standard procedures, and response rates remained within normal ranges. The establishment survey, however, saw a lower than average initial collection rate. This was attributed to the timing and length of collection periods, which was shorter than usual and concluded several days before the month's end. The report acknowledges the potential impact of the hurricanes on payroll employment estimates in certain industries. However, it emphasized that the establishment survey is not designed to isolate the effects of extreme weather events, making it difficult to quantify the net impact on national employment hours or earning estimates. The report also notes that there was no discernible effect of hurricanes in the national unemployment rate derived from the household survey. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below and schedule a meeting. Thank you again for watching. We look forward to seeing you next week.